This video is a complete guide to Ethereum staking. How does it work? How do we go ahead and do it? What are the pros and cons and what do we need to know? That will be covered in this video. Timestamps are down in the description below for everything. We're going to go through this, which is staking rewards that we can get, the different ways to stake, for example, solo staking, exchange staking, or liquid staking, and what this actually means. Restaking is something that you can do with Ethereum as well, which is securing layer 2s on Ethereum. And then with staking ETH, we can actually use this across Ethereum Dapps and use it within DeFi to earn extra yields as well. Do we actually want to do that? How much risk are we taking? We'll go through all of that in this video. First, we'll look at how Ethereum staking actually works to pay us money. Where is that money coming from? Where is the yield coming from? This is how Ethereum works. So we own some ETH tokens, and the way that Ethereum works is that you need to stake those on the network to help the network function. So we take our ETH and we put it on the Ethereum blockchain to help it do its thing. These guys over here are using the Ethereum blockchain. Each and every time they go through with a transaction, they have to pay a fee. And so that fee gets paid to the Ethereum blockchain for doing its job. Now, because we're helping the Ethereum blockchain do its job, some of that fee gets paid out to us for helping. And so the yield that we're getting from Ethereum is coming from the fees paid by users. So you can think of it as a dividend from the blockchain for us helping it do its thing. As of making this video, that is coming out to around 3.5%, but this yield changes dependent on how many people are paying fees. All of the resources I show you in this video, I'll link down in the description below so you can see these for yourself. This is a dashboard to see exactly what's happening on Ethereum right now. As we can see, Ethereum actually has an unlimited supply. That is, every single block, it creates new ETH tokens. Now, what we want is that the fees paid by users actually are more than that. Because as long as the fees are higher than the creation of new coins, we're actually getting a real yield from the fees. If fees are lower than the creation of new coins, then there's more coins being created by the protocol than the fees being paid. And that's not good because that's basically inflation. And we don't want inflation. That's not good for the value of a currency. So what we can see here is that the ETH supply is actually going down. And that means that a lot of fees are being paid. When fees are paid on the network, two things happen. Firstly, some of the fees are used to buy back and burn some of the tokens that are created with each block. That's good for us as investors because what it shows is that these fees are actually reducing the supply of ETH. And that's great. That means that the ETH that is remaining is going up in value, all else being equal, because there are fewer tokens out there. So we know that the fees being paid by users are over and above the token creation. Hence, the actual supply of ETH is going down. You can see the supply growth here is actually running at about minus 0.63% per year. And you can see the burn here. But we can see issuance from new coins, and the net is actually a burn, so a reduction in coins. So you get some of this burn, which hopefully is negative for the supply of ETH, which is good for us. And then some of that is simply used as a dividend out to people who are staking ETH as well. Like I said, around 3.5%. Here are the applications and users that are burning ETH, exchanges and other DeFi apps. So this is ultrasound.money, and it's good to see exactly how much ETH is being created or burned over a given period of time. There is only one way to stake Ethereum, and that is running the Ethereum blockchain. What you need to do is set up validators. So you need dedicated hardware, and you need to run the Ethereum software on that, and you need 32 ETH per validator. Now, obviously, investors don't want to do this. And so what we do is use exchanges or other middlemen who run all of the infrastructure and then just give us the rewards. And so that's what we'll look at now. But if you do want to stake yourself, known as solo staking, I'll leave this link below. The vast majority of normal investors simply want to stake our ETH and we don't want to run anything in the background. So we give our Ethereum to infrastructure providers like exchanges or other types of decentralized players. So what we can do is take our ETH and we can put it with Lido or Rocketpool or Binance. They do everything in the background and they just pass the yield back to us. So if we earn 5% yield, they're going to take a 10% fee for the trouble of running the infrastructure. If we earn 5%, they'll take 10% of the 5% and pass the rest back to us. Now, if we put our Ethereum with these providers, we of course need to know how much we've put with them. And if we want to withdraw that ETH, we need to obviously tell them, hey, look, we've got this much ETH with you and we want to withdraw it. So what they need to give us is basically a receipt. So if we put 1 ETH with them, they have to give us a receipt that proves that we have that 1 ETH with them. They're staking it for us. And so if we want to withdraw it, they can give us our 1 ETH back. And of course, we need to know how much yield that we're getting and earning from the fees. And so we can do that through these receipts that we have. We know that we have 1 ETH and we know that we should be receiving 5% a year on that receipt that we've got. And of course, they're not receipts, they're tokens. So when we put Ethereum with these providers, they give us a token back, which represents our staked ETH. So for Lido, they have staked Ethereum, which is stETH. For Rocketpool, they have rETH. And for Binance, they have bETH. So these tokens represent how much Ethereum you have with these different providers. As long as we're holding these tokens, we're getting all of the staking rewards. And of course, we can deposit and withdraw the tokens and do everything else that we want with them. Now, these are called liquid staking tokens because these tokens essentially represent staked ETH. And just like any token, you can do anything you want with them. So you can deposit and withdraw, you can buy and sell, or you can own it and keep the rewards that are coming to that token. There are many different players in the Ethereum staking space, and therefore there are many ways to go ahead and stake your ETH with them. For example, Lido is blockchain based, and so you need to use crypto wallets. You need to have Ethereum on the Ethereum blockchain, and then you can go ahead and stake with them. You stake, they give you the liquid staking token back, which is stETH, and that represents your stake plus the yield. This is all on the blockchain. We also have Rocketpool, which is again blockchain based. You can go to the application as long as you have a crypto wallet with ETH in there. You can go and press launch, and on the application, you're going to swap your ETH for rETH, and that's going to give you the staking rewards as well. And then you have players like Binance, which is a centralized exchange. And so you don't have to use a blockchain. They do everything in the background. But of course, your ETH is on a centralized exchange in their custody. And so there are different costs and use cases. Everyone can use the way that they want, either on the blockchain or on a centralized exchange. Liquid staking tokens are exactly the same as any other token. They just represent staked ETH, and therefore they have the same price of ETH plus any yield that is accrued. So you hold these tokens in your wallet or your exchange account, and they receive the staking rewards from ETH. You can stake your ETH on chain to receive these tokens if you want, but because these are liquid tokens and they are a token just like any other token, you can actually just buy and sell them on exchanges, either centralized or decentralized. You don't need to stake and deposit. You can just buy and sell. And if you buy and hold, you receive the staking rewards. You hold them just like any other token. You can send them between exchanges or wallets as long as you're using the correct blockchains. And whoever holds the token is receiving the staking rewards that are coming to that token. There's 2 different ways that those staking rewards can accrue to a token. The first is rebasing. Rebasing is where you have 1 ETH and you go and stake. For example, staked ETH is rebasing. So you go and stake with staked ETH and you have 1 staked ETH. You hold it for 1 year and you earn 5%. How does that 5% accrue to the token? You just have 5% more tokens. So at the end of the year, you have 1.05 tokens in your account, in your wallet. That's how the staking rewards are accrued. you actually have more tokens at the end of the year. The second way is a price accrual mechanism, whereas you have the same amount of tokens, but the tokens are 5% more expensive in relation to ETH at the end of the year. So price accrual tokens will actually go up in value versus ETH, whereas rebasing tokens should have the exact same price of ETH, but just have more tokens over time. Now we'll look at some of the Ethereum staking providers and exactly how they work. If you want to know exactly how to use DeFi or crypto wallets, these videos in the Crypto Investor course are going to help you out. I'll link it down below. You can also ask questions in the private Discord groups to me or the other members there, so you're not confused about anything. I also update this for free with a lot of research. I'll link it down below if you're interested. But what we need to look at now is how staking actually works. So we're going to look at Lido stETH first. So what happens with Lido, because it's blockchain based, is we need to get ETH into a crypto wallet, for example, MetaMask, or if an exchange actually lets us buy and hold stETH, then we can use a centralized exchange as well. From there, that is put onto the Lido platform and they go and stake it. And then they give us that stETH, which represents our stake. Here's some things about Ethereum or staked Ethereum from Lido that you might want to know. It's the most widely held liquid staking token as of right now by a long way. It's a rebasing token, so you get more tokens in your wallet over time to represent the yield that you earn. A lot of protocols and exchanges support this. You can stake and unstake on exchanges like Bybit for free. Bybit are great, so what you can do is just put the ETH on there, go through and stake it, and it's completely free. I'll link Bybit below and some other exchanges that I use like Binance. They give deposit and trading bonuses if you're new, so if you want to do this anyway, check the links down below for that. You can buy and sell this token on centralized and decentralized exchanges. You can stake on the Ethereum mainnet as well if you want to take self-custody of your asset. And on layer 2 on Ethereum, so if you want to use that, because the Ethereum mainnet is very expensive, if you want to use layer 2s like Arbitrum, Optimism, you can do that, and this token is there. However, it doesn't, as of right now, it doesn't accrue staking rewards on the layer 2. What you have to do if you want those staking rewards is actually bridge it back down to the layer 1. And then when you bridge it back down, the accrued yield that you've had since holding that token will accrue to your wallet. However, that may be costly. And so this is a drawback for right now, is that if you want to hold staked ETH on ETH layer 2s, then it's a little bit strange like that. That's why some people prefer to hold it in an exchange like Bybit, because it's basically free to use and you get all of the rewards. The downside is, of course, you have your assets on a centralized exchange, so there's a bit more trust that you have to have for doing that. If you want to use the Lido protocol directly, you have to go to the protocol website and connect your wallet. So lido.fi, I'll link everything below. Stake now on Ethereum. From here, we have to connect a blockchain wallet. So top right-hand corner, connect wallet. I'll connect my MetaMask and just choose the wallet that I want to connect. So that's fine. And then from here, it's going to read the balances in your wallet. And it shows me that I've got 0.15 ETH that is currently not staked. So what I can do is go down and stake this. I can press max. It's going to stake an amount right here with a blockchain fee. You can see I receive this amount of staked ETH. The transaction cost is very high because we're using the Ethereum mainnet, and Lido are taking 10% out of the rewards. So that is how you would deposit your ETH in Lido and actually stake it through them. However, on the Ethereum mainnet, fees are quite high, and there are other ways to actually get staked ETH as well. If you don't know how to use blockchain wallets or anything like that, I'll leave some other free videos down below as well, which shows you how to set them up and get crypto into your own wallet. Like I said, because liquid staking tokens are just like any other token, it doesn't matter how the token gets into our possession. So yes, you can use the Lido protocol directly, but you can also just buy the token on exchange. And so Bybit is an exchange that offers this. You can see staked ETH right here. What I'm going to do is go to trade and spot trading, and I'm just going to go through to the market here. And then from here, I'm going to search for stETH, which is the token, and you can see it right here. So if I click this, I can now buy this token just like any other token, and I'm receiving the staking rewards because it's in my exchange account. Now, from here as well, if you don't want to do that, or if you have a lot of ETH that isn't staked, you can go through to their earn section. We'll look at ETH 2.0, and this is where we can stake. So for right here, you can press stake now, and you're using the Lido protocol right here. But what Bybit are doing is essentially bundling up your transaction with a lot of other customers. And so that's reducing the blockchain fee because they can bundle it up into one big transaction and reduce the cost per amount staked. And they actually give you this for free right now. So what you do is you stake an amount of Ethereum on here, and it says, yeah, sure, we'll stake that and we'll turn it into stETH and we'll put that into your account. And you can see the APR that you're getting in your account right here. So that is actually a much cheaper, faster way to do things. And you don't have to use blockchains. But of course, you need to have your assets on a centralized exchange. So you have to trust the exchange that you're using. Binance's staking token is a little bit different to Lido's stETH. The big difference here is that it is an accumulating token. That is, the price of this token should go up in relation to Ethereum over time as staking rewards are issued. So it should get more expensive versus Ethereum over time. It's really a Binance token, so it's used on the Binance exchange and on Binance DeFi, on the Binance Smart Chain and other Binance chains. It's also on Ethereum mainnet as well. And you can use the Binance exchange to stake and unstake for free. And you can hold it on the Ethereum mainnet and also on Binance chains like OPBNB or Binance Smart Chain, which are obviously a lot cheaper. How to do this? Simply go to the Binance exchange, get some ETH in your account, press stake ETH right here. I've got an amount of ETH, so we'll just click max, and that turns it into wrapped bETH. So we can see here that the amount of wrapped bETH I get is actually less than I'm putting in on ETH because this token is more expensive because it has accumulated staking rewards over time. Press stake, and that's it. 3.37% is what you get in your Binance account right now just for holding that. You can trade it on the exchange for other tokens easily if you don't want to wait for it to be unstaked, because there are periods where you have to wait, or you can simply withdraw that to your own wallet to have self-custody of it if you want. Rocketpool ETH is another accumulating token, so the balance goes up versus ETH over time. It's more decentralized, this one. It's really only in DeFi and in wallets. Centralized exchanges don't really support this very well, mainly because they have their own versions of these tokens and they want to get the 10% fees instead of Rocketpool. But if you go to the Rocketpool site, you can press launch on the application, takes you through. All you have to do is connect your wallet down here. Up on the top right, you can see my wallet is connected and I have an amount of Ethereum. It's going to turn it into the Rocketpool ETH for me. As long as I hold that token, it's going to be accumulating the rewards. Rewards are a little bit lower than stETH and others right now. So as you can see, yields are a little bit different per staking token. So that may factor into which staking token that you actually want to use. If you want to use the protocols directly on the Ethereum mainnet to stake, that's expensive. Centralized exchanges are completely free, but are centralized. And so in the middle of those comes layer 2s, Ethereum layer 2s, which let you keep self-custody of your assets, but they're a bit cheaper. So what we can do is find out if the tokens that we want are actually listed on these layer 2s, and then we can just go ahead and simply buy them on exchanges on these layer 2s. So as we know, stETH is on layer 2s, but you don't accrue the staking rewards in the layer 2 until you bridge it back to layer 1. So not great if you're looking just to accumulate your staking rewards in a cheaper fashion. So what we'll do is search for rETH, and this is right here. You can click on that, and then we can see where this token is actually listed. So if we go to the contract info right here, I can see that rETH is on Optimism and Arbitrum and Base, which are layer 2s on top of Ethereum. This is much cheaper. And so what I need to do is get some ETH into my wallet on these networks, and then I can swap the ETH for rETH on an exchange. So we'll go over to the 1inch exchange. Now, if you don't know how to set up wallets or get Ethereum into a wallet, I'll leave that for the video guides linked below on how to use MetaMask or other wallets. And all you do is just buy Ethereum on an exchange and then withdraw it to your wallet. I'll leave it for those videos. But given that we have some Ethereum in a layer 2 wallet, what we're going to do is go to change to Arbitrum. So I've connected my MetaMask here and I want to change to the Arbitrum network. And I'm on Arbitrum right now and I have some ETH in my wallet. So what we can do is switch that into the token that we want to hold, which is rETH. We can click this. And now what we're going to do is swap the value of our ETH into this staking token. And we're holding it in our self-custodial wallet, but we're holding it on a layer 2 like Arbitrum. Fees are going to be way cheaper, like 10 to 20 cents per transaction. And so that reduces costs and we still keep self-custody. So you can have it on the Ethereum mainnet, which is very, very expensive. You can have it on a centralized exchange, which is totally free, or you can use layer 2s, which have some small downsides in terms of the asset selection, but you keep self-custody and it is a lot cheaper to do things on the blockchain. If you want to know more about liquid staking tokens, there's an amazing June dashboard for this, which I will link below as well. It gives you all of the breakdown of the data, how much ETH is being staked, how many validators there are, what the yield is, who are the largest providers and how much stake do they have over time, and how is stake being deposited or withdrawn. I won't go through it, it's self-explanatory, but I'll link it below if you want to have a look. So there are many ways to get an LST into our possession, either in wallets or in exchanges. And so we're earning right now, as of making this video, around 3.5%, maybe somewhere up to 4% in yearly yield back on the Ethereum that we hold. That's great. And what's happening with Ethereum now is that layer 2 networks are being created. These layer 2 networks reduce fees and they have different use cases and different people are paying fees and transacting on those layer 2s. And so what has come about from this is restaking. When we stake Ethereum, what we're doing is helping secure the layer 1 Ethereum blockchain. As we saw at the start of the video, we stake, people pay fees, and we get the majority of those fees paid back to us for putting our Ethereum at stake in the protocol. But because Ethereum now has layer 2s, it's basically the same thing at layer 2, where you have layer 2 networks who want to pay us a fee to use our staked Ethereum. Because staked ETH in a proof of stake network is security. And so these layer 2s, they don't want to set up all of the infrastructure themselves. That's very expensive. And so what they want to do is pay us money for our staked ETH so that they have the same security. And that's what happens with restaking. What we're doing is we're taking our layer 1 staked ETH and we're saying, hey, you can use it too on the layer 2, and they pay us an extra fee for that service, for our security. So restaking is where you take the layer 1 liquid staking token and you give it up to the layer 2 as a restaked token on the layer 2. What's the benefit of this? Well, we keep our 3.5% yield on the layer 1, which we're getting now. That can change. But we also get an extra payment from these other providers who are paying us for our stake. So we get the base yield on the layer 1, which is 3.5, plus whatever they pay us extra. They pay us for what's known as AVS, or actively validated services. So this is data availability layers, layer 2 networks and validators there. So because we're giving our stake to them, they pay us extra money. And you can see how that works right here. So we're getting extra on top. So extra staking rewards for us. What are the downsides? Well, there's more complexity here for sure, because staking Ethereum on the layer 1 is pretty simple. We're just getting fees from people. That's it, right? If we use Binance or Lido, they've been going for a long time. And so they're running things pretty well. But when you're giving your stake up to layer 2s and potentially many layer 2s, some of these are going to be not really that reliable. And the problem there is that with staked Ethereum, if you run validators poorly, your stake may get slashed. That's a penalty for running the network poorly or not being there when you're supposed to be. And slashing reduces your staking yield. That's a risk. And so that is an extra risk, especially if you're giving your ETH to, loads of different layer 2s and services, you don't really know what's going on. So definitely an extra risk for the perceived yield that we're getting on top. There's a higher slashing risk, and there's just more complexity, right? Because what we're doing is we're taking this in this protocol, We're then giving it to this protocol, who's giving it to these guys. And so you can see there's extra risk here. Restaking is not leverage. You are not leveraging up anything. You are just taking your liquid staking token and you're giving it to layer 2s. So it's pretty simple. You're giving it to other people. They're paying you a fee. But because you're giving it to so many other people who are new, there may be some extra risk of slashing. But this is something you can do, and this is something that's coming into the Ethereum protocol. Restaking is done through infrastructure providers. And so they are kind of a set of smart contracts where they take in liquid staking tokens and they restake them to other parts of the network. And one of the main ways of doing this is using EigenLayer. There are going to be many liquid restaking providers or LRT providers. EigenLayer is one of the first. And so we'll go through exactly how that works. Many will work in the same way. It's restaking infrastructure. What you do is you take your LSTs and you put it within EigenLayer. EigenLayer actually let people run validators directly with them as well. So if you have a validator with 32 ETH, you can simply reroute your ETH into EigenLayer and they restake it for you as well. Now you can use this, the restaked ETH, what they do is they take it, they use it over layer 2s and DA layers like we've just seen. EigenLayer can be used directly, so you can go and use this yourself and connect your wallet, but it's more of an infrastructure thing. And so many other protocols actually just implement this themselves. So what you do is go to a protocol and just say, here's my liquid staking token, use EigenLayer for me. And they may have, a dashboard that you can use and some other incentives that you might want to use. What happens is that EigenLayer locks your stake and you can't use it within DeFi. So if you're staking within EigenLayer for right now, it's basically in EigenLayer and you can't do anything with it. You can withdraw it, of course, but it's either in or out. And so what these agent protocols do, like I just said, is they actually make your liquid restaking token liquid by giving you a receipt of what's in the EigenLayer. So you take your ETH with the agent, they put it in EigenLayer, and just like liquid staking tokens, they give you that receipt token, which is freely tradable. And so what people can do is use that LRT in DeFi. If they have it in their wallet, they're getting rewards. They can sell it on an exchange, or they can actually use it in DeFi to earn extra yield on top in many different ways. A quick overview of EigenLayer and exactly how it works. It's incredibly simple, just like the liquid staking protocols. So EigenLayer, restake. From here, you just connect your wallet and we'll connect a wallet up in the top right-hand corner. So if you have a liquid staking token, like we've just seen, Binance staked ETH, Rocketpool ETH, Lido staked ETH, you take those tokens and they're earning 3.5%. And you just simply stake it in EigenLayer. So you connect your wallet and you deposit. That's on the Ethereum mainnet, and you'll be getting restaking rewards. Now, as of making this video, restaking doesn't actually exist. It's not actually happening. The infrastructure is still being built out. But what's happening is EigenLayer is, of course, coming to market, and people want to be in there, for any rewards that come. So there is extra risk for doing this. You're putting your LST within the restaking protocol, and you expect to earn extra rewards from what EigenLayer is doing with the stake across layer 2s that are paying you fees for your stake. Restaking Dapps give us liquidity of our restaked tokens. Like EigenLayer doesn't give us liquidity, it locks them in the protocol. We can withdraw them, but we can't use the tokens in a liquid fashion. Just like liquid staking tokens. It's either locked in or out. And then the restaking dApps allow for liquidity of our LRT, so a liquid restaked token. So they restake our ETH in EigenLayer and they give us these LRTs, these liquid restaked tokens, so we can trade them and use them in DeFi. Some of these protocols use LSTs, liquid staking tokens like staked ETH or wrapped wbETH or Rocketpool ETH directly. So you can just give them to the protocol, they put it in EigenLayer, they give you the LRT back. Some actually directly run validators, stake your ETH, and do that directly with EigenLayer, and then give you their own liquid restaked token back. This is another layer of protocol risk, because what you're doing is staking with the liquid staking token, then using liquid restaking, and these protocols on top. So there's a lot of extra moving parts, smart contracts, and things that could go wrong for sure. So be fully aware of how they stake and if they use ETH directly or if they're just using a liquid staking token and kind of restaking for you. You can see the risks are adding up. A lot of smart contracts, layer 2s and things. Things are definitely going to go wrong here in some of these, liquid restaking protocols with so much stacked on top of each other. What we can do is go to June Analytics. You can see the most popular liquid restaking protocols. So for right here, Ether.fi or Ether.fi, Puffer Finance, Kelp DAO are the top 3. And you can see how Ethereum is flowing into these protocols over time, looking to restake their ETH. So I'll link this down below as well, but we have 3 billion in TVL and over 1.1 million ETH staked or liquid restaked right now. So one of the protocols, Renzo right here, if you connect your wallet, you can use ETH directly, but you can also use staked ETH or wrapped wbETH. So these are liquid staking tokens. They put it in EigenLayer for you. You get, of course, Easy ETH, as you can see here, which is a LRT, which represents your restaked LSTs. It gets a bit complex. You have your Easy ETH, you're earning the rewards, and of course you can use this across DeFi, you can buy it or sell it. We also have Puffer Finance, which was given some money from the Ethereum Foundation, a grant from the Ethereum Foundation here to actually launch their token. So again, you can just simply connect your wallet and restake in here. And then we have Ether.fi or Ether.fi. You can go to stake ETH. So you just put your ETH with them. Now these guys run validators directly. And so they aren't using any liquid staking tokens. You just directly stake Ethereum. They give you EETH, which is your restaked token in EigenLayer. Go to your portfolio. You can see how much EETH you have. That's earning rewards just like any other LST, around 3.5%. And then you get your EigenLayer APR. You can see restaked APR. So that's in EigenLayer, and whatever it's earning, it's going to come back to your token as well. And so what we have here is EETH, which you can't use across DeFi, but you can wrap it into wrapped EETH, this one here, and that's liquid, and you can use that across DeFi. So you can see all of these DeFi protocols where you can put your token that's earning these rewards into DeFi protocols, which may actually be earning even more on top from DeFi. So people that pay fees for trading the tokens in and out, there's again extra risk here, but potentially extra yield on top for using in DeFi. Because all of these tokens are supposed to be liquid and tradable across DeFi, we can use our LSTs or LRTs in DeFi pools. And the reason people do this is because on DeFi, if you provide liquidity into DeFi applications, you earn trading fees. So if you have liquidity to provide, you get paid for that through the trading fees paid on DeFi protocols, decentralized exchanges like Uniswap, Curve, and then many others that are across layer 2s. And so what we'll do here is look at some of the yields that we can get and how this actually works. So we're going to use a protocol called wbETH, which is essentially a DeFi dashboard and automation application. So what you can do is actually use DeFi pools right through wbETH. Using DeFi pools is very complex because you need to provide liquidity into the pools and you need 2 tokens to put into a pool. And so you have to go through many transactions and you have to calculate properly just how much of each token that you need. Well, wbETH automates all of that. I don't want to promote wbETH in any way, but it's a good dashboard to explain what we're looking at. So what you do is you take your ETH, you put it into a protocol like this, then you use one of the chains, Ethereum or layer 2s. You use apps here on these layer 2s, and then any trading fees or other incentives of everything else, it gets lumped together and it comes out in a yield. Now, the reason people do this is because they want exposure to ETH. They want price exposure to ETH. That's what they want to be long. But of course, if you're looking for yield on top, then you can just go staked ETH, which is lowest risk, lowest yield. And you can stack on as much risk as you want and complexity to come out with some yield on top as well. So bETH is a yield farming platform. What you can do is use it to zap in and out of pools and potentially earn extra staking yield on top. The downside here, again, just like with DeFi, is it's smart contracts upon smart contracts upon smart contracts, DeFi pools, risk of protocols. Which protocols are you using? Are they trustworthy? Do you know exactly what's going on? And moving in and out of pools is always expensive because you eventually have to pay trading fees to come in and out of the pools as well. So there's many things to consider, but we'll look at bETH here. And what we can do is look for the asset that we want exposure to. So I've typed in stETH here, stETH, so that's the Lido token. And it doesn't really matter if we're earning yield on it on a layer 2 or not. What matters is the actual APY that we're getting, because we want that Ethereum price exposure. And Ethereum is traded against stETH. And so if the blended yield is very high, then that may be something that we want to do. So for right here, what we can see is that there are many pools and you can search by APY. I'll just show you this pool right here, which is on Uniswap, and you can see it's on the Optimism network. So Optimism is a layer 2, so we know we're getting cheaper fees. And for right now, we're trading wrap staked ETH, which is Lido's staked ETH. And when it's on a layer 2, they have to wrap it. So it's known as wrapped staked ETH. And it's trading against plain ETH. And the yield right now is 8.2%. So we can click onto this and see exactly what's happening. What's happening is that this is a Uniswap pool. Uniswap's a trusted decentralized exchange. So, that's something we can look at. And we're getting around 8% right now from trading fees that are being paid to people that provide liquidity. So if you want to do this, there's one thing to be aware of. When you provide liquidity to pools, you are putting your liquidity in a pool, and every pool has parameters that make sure that the price changes based on supply and demand. Now, in decentralized pools, there is something called impermanent loss, or IL. Essentially, if you have 2 tokens in a pool, which you always need, so you have 2 tokens and they come into the pool, each one of those has a price in relation to the other. Because those 2 tokens are what people want to trade, there is an exchange rate between them. If those 2 tokens come in very, very close, like 1 for 1, right? That's the exchange rate. And then suddenly the exchange rate changes by 50%. The 2 tokens in the pool are now different in the supply that they have in the pool, because the exchange rate changes dependent on how many people are supplying and taking out. And that's how the price changes. The more the price changes in a pool, the more impermanent loss that you have. Impermanent loss is not good, because when you take the coins out of the pool, you solidify this impermanent loss. You make it permanent. So the more that the price changes between the 2 tokens, the more impermanent loss that you suffer. And that reduces the yield that you're getting from the pool and the fees. If the 2 tokens never change in price, then there is no impermanent loss. And so what we do when we use liquidity pools in DeFi is we always look for assets that aren't going to change a lot in price, because we don't want impermanent loss. And so why using liquid staking tokens is good here is because the liquid staking token is basically ETH. And on layer 2, Lido staked ETH doesn't actually change in price until you withdraw it down to the layer 1. So what we can know is that if we're providing liquidity in a pool with wrap staked ETH and ETH, impermanent loss is going to be low to 0. You can actually come down here and it says that very low or 0 expected impermanent loss. It's a good thing. That means that the yield that we're getting in the pool is going to be more or less what we're actually getting. We don't have to worry about impermanent loss. And so we can search for liquid staking tokens or LRTs that keep their value versus ETH, which is going to be the same value. Now, if you're using liquid staking tokens that rise in value and are accumulating tokens like wrapped bETH or rETH, you're going to suffer some impermanent loss. But the amount, because it's only what, 3% or 4% a year difference, the impermanent loss may not be a lot. And so you have to judge that depending on how long you want to provide liquidity for, because each year the impermanent loss will get bigger and bigger. So you have to keep that in mind. I'll link an impermanent loss calculator down below. I'll just show you how to use it. Very simply, if you have rETH that's coming into a pool versus ETH, so ETH is obviously just $1, right? That's the reference rate. So you don't have to put the real price in. It's $1 versus something else. rETH will be coming in at, let's say, 1.04 because it's already accrued 4% versus ETH before. And if future prices, well, ETH is going to be exactly the same. That's the reference rate. So it doesn't matter if it goes up or down. That's the reference rate. So we know that that's for 1 unit of ETH. There will now be, after a year, 1.08 rETH or something like that, because that's an accumulating token. Over that year, it's accrued 4%. You can see your impermanent loss is 0.02%. So this is fine, right? It's not a big deal, because if you're getting 12% in the pool, no problem. You've definitely made up for impermanent loss. But of course, if you're using very volatile tokens, that can be a lot bigger. Something to be aware of. You can work it out with that calculator. I'll link it below. Adding liquidity to DEX pools is obviously very complex. Beefy automates this for the most part. So what we can do is add liquidity to ETH and wrap staked ETH pool. This is on Aerodrome, a decentralized exchange on the Base network. And so here we can deposit ETH. So you can use these protocols yourself, add liquidity to the pools. You get these receipt tokens for your liquidity. You can then stake that liquidity pool token within Beefy. Beefy is an automated strategy. So it takes all of the incentives and other fees and wraps them up and reinvests them back into the yield farming, essentially. If you don't do this, what you end up with is a bunch of incentive tokens of decentralized exchanges, which you don't want. So what this does is yield farms all incentives and fees and puts it back into the asset that you actually want exposure to, which is ETH in this case. So what we can do here, you can see if you've provided liquidity on the decentralized exchange, you get the receipt token for your liquidity. So you can actually put that into Beefy to yield farm and recursively put money back into that strategy. Or what you can do is basically let Beefy do all of that through smart contracts and just say, I've got some ETH, so I've got an amount of ETH, I want to do this, and it does everything for you. So it's going to wrap your ETH to wrapped ETH, it's going to swap it on Kyber Swap, it's going to build the liquidity pool for you, right, and everything else. And all you do is just press stake. That's a lot of stuff going on. And so you'll be paying fees and everything else. And so there will be a lot of money coming out of what you've just paid. So you have to go through this anyway, but there are fees and complexity within here. And one of the downsides of all of this is that incentives across DeFi usually run out after a certain time. So what you have to do is constantly, move your ETH from one protocol to another protocol, in and out, and trading fees are going to be taken out of your yield. So it's definitely more for active investing, and you have to keep an eye on it. However, the yield, can actually be double or more just staking. And so maybe investors want to do this or not, it's up to them, but that's the mechanism of how it works. I do have specific video guides on Beefy and all the other protocols. I'll list them all below. I don't recommend using them, but of course, if you do want to use them, everything's there. This is another protocol, which is Pendle. Pendle is a way to fix or sell forward the yield that you're getting from an LST or an LRT. So this is a yield derivative protocol. And of course, if we own a token that we know is going to accrue interest or dividends over a 12-month period, we can sell that forward to someone else. So if we have a token like liquid staked ETH, and we know that it's going to get 3.5% over the next 12 months, we want to fix that because liquid staking token yields, Ethereum yields, are variable. It might go 3.5, maybe 2, maybe 6, we don't know. Of course, people that earn yields from something may want to fix that yield. other people may want to actually pay us that fixed yield because they think the yield will be higher. So what something like Pendle does is say, hey, you've got this token that's earning yield, and you can simply enter into a smart contract with someone else. So what they do is they split the token up into the yield token and then the principal token. Essentially, the principal token is where you can fix your yield. So you go in and you say, I want exposure to ETH, and I want to fix my yield at 3.5% for the next 12 months. That's it. But of course, other traders may say, we think that fees are going to go higher over the next 12 months on ETH. And so we want to pay you 3.5%. Why? Because we think the yield is going to be 6%. And so they're taking a risk by fixing your yield for you, but they can potentially earn much higher yield. So it's just a marketplace for yield where you can either fix your yield or you can take basically a long position on yield if you think the yield is going higher. So what you can see here is this is the marketplace for yield. On staked ETH, you can fix your yield for around 4.6%. So let's click into here. Now with this contract, it's basically a contract with someone else. You need to say, well, how much are you fixing my yield for? And how long is the contract for? Because it can't go on forever. So you have expiry dates. So this is the 28th of December 24. This is 25th of December 25. This is 30th December 27. So if you're someone that says, I want to fix my yield for ETH for the next year or two, click the expiry, whatever that may be, and then just put in the amount of ETH. In fact, you don't even need staked ETH here. What you can do is just use the value of your ETH. You can put in an amount and you get essentially ETH plus this fixed yield. And then when it expires, you get it back, right? You get the yield plus your ETH back. Now, because this is DeFi, you can actually trade in and out of this token whenever you want as well. Again, too much for this video. Pendle and the other apps that I'm using here, specific video guides for all of them. But as we can see, if you have a token with yield, you can fix the yield that you get and someone else is going to pay you for that. Or of course, you can use the other parts of Pendle to actually go long yield if you think yield is cheap right now. These are the liquid restaking tokens right here. So we'll look at ETH. Now, as of making this video, if you're staking in EigenLayer with the LRTs, you're getting EigenLayer points, which people think will be an airdrop. And so what's happening is anyone that owns the tokens right now is potentially getting airdrops and other incentives towards that token. And so people are willing to pay for all of the yield that comes to that token over the next few months. And they're willing to pay you an annualized rate of 26%. There's only 133 days to expiry. So, you know, it's less than 26% that you'll be getting, but that's the annualized figure. And so you can either say, I want exposure to ETH and I want to fix my yield at this. Or if you want to use Pendle and say, I think the yield will be much bigger, you can just buy the yield and obviously you take that risk. So DeFi lets you do anything. This is fixing yield of tokens that you may have. Some people may want to fix their yield so they know I'm going to get ETH price exposure with a 4% yield and I'm happy with that. Some people may just not want to do that, let the yield that they get fluctuate, and some people may want to buy that. You can do that across, protocols like Pendle. All of these specific video guides on wallets and other apps I'll leave down below. And the Crypto Investor course, if you want to get a bit more serious, I'll link that at the top of the description as well. I'm James with Money ZG. Cheers for watching, and I'll see you in the next one.